Hey everyone, Paul here, and in this video I'm going to talk about Duluth Holdings stock. I think that this could actually represent a really good opportunity. I think a part of that is because it's actually a small cap stock. I mean, their market cap is only worth about $400 million, so it's a little under the radar, not something that everybody's heard about. They've also only got 65 stores. We're going to get into where those are located, but before I go any further, I also want to give a big shout out to everybody who has subscribed to this channel so far. I actually just hit 200 subscribers today, and that was a big milestone for me, so definitely want to say thank you to everybody who has subscribed. But also, if you're interested in stock analysis, personal finance, any videos on that content, I'm going to continue to be posting good videos out there. So if that's interesting to you, or is going to be of value to you, it would really help me out if you could hit subscribe to this channel. But that being said, let's get into the analysis on Duluth. So when we look at it, there are three main things I'd like to talk about why I think this is an attractive stock to invest in, for the next, at least couple year horizon, which I like to invest, thinking I'm going to be investing in this, for at least a year, preferably longer. But 2020, I think, has really kind of exposed a lot of retailers to figure out, do customers connect with a brand enough to want to go and buy, from an e-commerce channel or buy from their website. And Duluth is a company that they have stores. They have in the past focused on really kind of expanding a lot of stores, which has hurt their profitability a little bit from trying to focus on building out that physical footprint. But so far in 2020, their online sales have more than offset the lost sales from in-store visits. So their sales are actually up over last year, again, because e-commerce is more than making up the loss in the physical stores, which I think is a really promising sign for this company. And the fact that they're actually getting better, they were already, getting involved with digital ads before, but they're shifting more of their ad spend, from traditional media and into, social media advertising and things of that nature. So I think that they're seeing a lot higher of a return on investment from those. So I think that 2020 has kind of really been, a net positive for Duluth, okay? Which brings me to the next point. So point number two that I think is really good as far as making this a good investment. The fact that they were, as I said, opening a lot of stores and focusing on that. Well, in 2021, they only have one store planned to open. And what they want to do is they've kind of called out, and the management team has said that they want to take a look at all of the online purchases with their direct selling. And they want to say, okay, what markets are people ordering a lot of our stuff, or we don't have a store? And is that an opportunity for us to explore those markets next? So again, I think once again, 2020 has helped them identify some key markets where customers want to buy online, okay, and then it's going to give them an opportunity to be a little bit smarter about where to place those stores. And I think they're going to start doing it with a little slower pace, which I think is going to help improve their free cash flow and improve their profitability. Because one of the knocks on Duluth, by the way, because when we look at this company, you look at the stock for the last 5 years, in the last 5 years, I think they're down about 20%, but they're essentially just kind of running flat across, okay? And, certainly with the pandemic, they kind of fell off a cliff along with a lot of other retailers, a lot of other companies. But that being said, I think a big reason for that was that they were growing, but they weren't growing profitably. But their focus now on the digital side of things, I think, is going to help them not just grow, but grow profitably, which I think is going to be a positive catalyst for this stock going forward. And then the final point, point number three about what I think makes this a great investment is that when I'm running my analysis on this, I think I can pretty conservatively get to a $16 price target with Duluth stock. Now, it most recently closed on Friday, December 18th at $11.48. So when we look at that price target there, that implies a near 40% upside if I am going to be correct about that. Now, I also said conservatively $16. Now, I think my more aggressive case, it's a little bit more of a reach, but I could also pretty easily get to a point here where I could see the stock being $20 a share. Now, if you're interested to know how I'm actually calculating that price target, anything like that, I'm going to put it down below in the video description where I start talking about that. So if you want to jump ahead just to that point, I'm going to include that for you, so you don't have to watch the whole video if you don't want to. Would love it if you do, but if that's something that you want to just jump straight ahead to, I want to make that easy for you. So here again, we can see Duluth closed at $11.48, as I mentioned, on 12/18, and that was actually down 3.69% on Friday. We look at the share performance over the 5 years. Now, this did actually go public The stock started trading in late 2015. So, this has been public for about 5 years. And it's down about 21% over that time horizon. We step back and we look at just the past year, it's up over 17%. But if we go back to that 5-year view, we can see the fact that, really since 2018, they were up over $30 a share, and they were steadily declining. And so even before the pandemic hit, so you look at the end of the year 2019, they were only trading as high as about $10 a share. And a big reason for that decline is, once again, they were growing. So this company has, continuously grown their sales year over year. So they're a growing company, but they were growing without consistent profitability. And I think that put a lot of strain on investors and on analysts to really justify investing in this stock. And then, of course, when the pandemic hit, they fell as low as $2.80. So, on the intraday low, they got down to $2.80, really fell off a cliff. But then they rallied quite strongly from that low, by over 400%. So they went up to close to $14 a share, or I'm sorry, actually over $17 a share at their high there. So they had a huge rally from that low, which again has been a pretty common theme for a lot of these stocks that were really beaten up the most, and had some ability to have online sales. A lot of those stocks fell off a cliff, but then they were able to rebound quite strongly. So we saw this go all the way up to over $17 a share, and then now it's most recently pulled back to where it is at $11.48. Now, what's interesting is that, that $17 when it was trading up around there was kind of at the end of October 2020. So by the end of October 2020, this stock was already trading just a little over where I think the fair value is. So I don't think that it's any, kind of stretch of the imagination to see this stock actually returning to that level, especially since it was so recently at that $16 price point, or over that $16 price point. So I think, that's a little bit about the share price performance, so a little bit about the history, and kind of just putting that in context about what I think, how realistic that price target is, given that it was actually just at that price target back in October. So that being said, now let's move over and get into the company overview. And getting into the company overview, what I'm going to do is I'm going to pull up an investor presentation that is on the investor relations website for Duluth. And I really encourage you, for any stock that you're going to be looking at, there's a lot of really good information on the investor relations website. And for any stock that you're looking at, you can just type the company name, investor relations, and Google is going to give you that pretty much as the first search result. You go over there, they're going to have information about financials, investor presentations, a lot of good stuff. So let's jump into that investor presentation that Duluth has on their site. Okay, so let's take a look at the at a glance for Duluth. And with this, Duluth is a company that is really focused on, high quality apparel products. They're really going to put together a lot of things that are going to be, warm items. They're going to be items that, they're going to be the fast drying shorts. So they're going to be, if you're going to be outdoors, if you're going to be like on a work site, anything of that nature, Duluth is going to be kind of the primary target for those customers. They really made a name for themselves with kind of their humorous and distinctive marketing, as they're calling out here, but their commercials, if you haven't seen them, are actually pretty funny. I think that it might be worth taking a look at those commercials if you're thinking about investing, but certainly I think they do a good job with those, and the fact that they want to do a better job of not just having those on TV, but having those on social media, as we talked about, where they're seeing a higher return on investment. And then, of course, down below, we see that they want to focus on the nationwide omni-channel presence, and thinking about it again, about saying that they want to have, physical stores as well as their online distribution. Here we take a look at the net sales and adjusted EBITDA, and if you look at it, so the sales trends for this is, like I said, every year they've been growing their sales, and 2020 is no exception. Even with selling more online versus in person, they continue to grow their sales, but they have been growing at an annual average rate, or their compound average growth rate has been 18% from 2014 to 2019. So strong growth there, but you can also see, so they've been growing their EBITDA, so their earnings before interest, taxes, depreciation, or amortization, they've been growing that by 12%, so less than the 18%, and that has been in part, again, due to their rapid store expansion. But the fact that they're cooling off on that now, focusing more on the in-store, again, I keep kind of hammering that point home. I think that's going to help turn that trend around and help get their EBITDA growing faster, or at least as fast as their net sales, right? So there's some of those trends there. And as far as building the brand awareness, so we kind of come over here, right? So we see that digital advertising is the #1 thing on this. And before 2020, we wouldn't have seen on an investor presentation digital advertising being the #1 focus for this company. But they want to focus on paid for search and banner ads, social media, organic and sponsored, as well as targeted emails. Now they do still want to have a presence with TV advertising, just not to the extent that they used to have. They still will have catalogs, again, that will be a little bit reduced, and then still have a presence with the local marketing. Okay, and so now we can take a look at actually where those stores are. So again, they currently have about 65 stores. We can see where they're located throughout the United States. Now they are located coast to coast, but what's also interesting is that they highlight where the stores are. They also, and I think this is really valuable, they highlight where they're actually selling the most. So they have a little heat map below that, and you can see that they're selling a lot of merchandise in some areas where they don't already have stores. So they're selling a lot in California, they have no stores. They're even selling a lot in Florida. If you look at the heat map, they don't have a lot of stores. They're certainly selling a lot in the Northeast. It looks like they could actually justify having more stores there. But in total, they're saying that they have the potential with 100 stores that they've identified that they could move into. And again, they want to be able to utilize that, all of the data from 2020 and before, but certainly there's a lot more of it online purchases in 2020. They want to lean on all of that information to figure out where to strategically start placing some of these stores. And why do they want to do that? Well, this was actually kind of interesting to me too, but this was talking about, how valuable is a customer when they actually have the retail segment versus just the online segment, right? So this is talking about retail stores to help attract new, more valuable customers. So, if they're, California being a good example, if they don't have a store presence there and they're only trying to go online, well, this kind of gives you a look at the differences between those two. So first of all, looking at the multi-channel buyers, that if you're a retail buyer versus that direct segment buyer, you're spending about 2 times more, okay? So again, if people in California already like this and there's a store, you can kind of get them to kind of get engaged in that way. They're gonna spend about 2 times more. You look at the multi-category buyers, okay? We're seeing that same thing, about 2 times higher for the retail buyer. And then finally, when you just look at it on a per customer basis, your retail buyer is spending about 19% more, okay? So almost 1/5 more than what the direct segment alone is spending. So I think that's some of the justification to say that they don't want to entirely move to online. They still want to have their physical store presence because of some of the trends and numbers that we're seeing here. And this is also an opportunity I think the company's really seeing an opportunity with. I think, at least initially, I think Duluth was kind of thought of more or focused on more of marketing to men. But the women's business has actually grown really significantly, and this is something that the company wants to place a growing emphasis on. So the fact that, most of the apparel, or not most, but a lot of the apparel has been geared towards men. I think the fact that there is that opportunity to, go after more of the women's segment represents a further kind of room for growth for Duluth. All right, and finally, I want to get into the valuation model that I put together. So this is just what helps me think about what I think a stock could be worth. But if we look at this, so in the upper left-hand corner, I have the share price where it closed at on December 18th, so that 11.48. I've got their market cap of 376 million, or basically 377 million. So keeping in mind that is a relatively small company, when you think about it in terms of how big Apple is, so Apple is a $2 trillion company, which is $2,000 billion, okay? I mean, like, just crazy numbers, whereas Duluth is $0.3 billion. So $0.3 billion for Duluth, $2,000 billion for Apple. A little silly to compare Duluth to Apple, but if you wanted to understand just how drastic that size difference is, there you go. When we look at the shares outstanding, Duluth currently has over 32 million shares outstanding. Now, they haven't really been diluting their stock, which is a good thing, of course, because if they dilute their stock, it makes each individual share less valuable, other things equal. But that being said, I think that I'm looking at this valuation over a 10-year horizon. So I'm trying to say, like, what do I think that they could be worth by 2030? And in doing that, I want to assume a little bit of dilution. So I'm going to say that, what would happen if they actually were going to, issue another 25% of their shares? So if they were going to say that they would end 2030 with over 40 million or 41 million shares instead of their 32 that they currently have. And what that does is that when we start doing the math to say, what's their, market cap per share, all of those things, we want to take into account that potential dilution, because if we don't, then we're really overstating that share price. So I'll get into that when we cover that portion below. I also have here, so the full year for 2018 and 2019, we have those results. And for 2018, 2019, they grew their sales year over year about 8.4%. We saw that earlier in the investor presentation, that they've been growing their sales year over year, every year consistently, which is a great sign for a company, of course. Now, the next thing is down here, we've got this section for revenue and then our year over year growth. And this is going to show that, okay, if we have our year over year growth growing by 7%, then by 6%, and then a steady state of 5%, from basically 2022 to 2030, if we have those numbers plugged in, we would say that they would end 2030 with revenue of over $1 billion. So they would be increasing by, they'd be about close to doubling their sales if they were to grow at these rates, okay? And if they did that, then always the question is that if you know or have a projection for what a company's sales are going to be, the next question is, what do you think investors are going to pay for those sales? And so once you know the sales, once you know what investors are willing to pay for those sales, you then have the projected market cap for that stock. It's really that simple, from a math standpoint. The really hard part is figuring out, again, what the sales are going to be and what investors are willing to pay. But if you knew those two things, it's just math. You multiply those together. Now, I have that as an input over here, and I'm going to start out saying that investors by 2030 are going to pay 1.2 times sales. And this is a company, by the way, that currently is actually trading at less than 1 time sales. So I think investors are not really giving this a lot of credit in a lot of ways. I think that the fact that they are growing at the rate that they're growing and consistently growing their sales, the fact that they have the tailwind of the e-commerce being a positive for their business, I think that's really understated. But I go back to, again, I think when you have a small cap stock, I think that you have opportunities to find some under the radar investments, because I don't think everybody's, has an eye on this. I don't think everybody's aware of this just because of how small it is, okay? So we started out with that 1.2, and then we get over here, we come and we look at, in the lower left-hand corner, we see our projected market cap is, again, now, 1.08 billion times the 1.2, which gives us about 1.3 billion. So we're saying that, okay, right now, in late 2020, they're worth about that 377 million, and we think that their market cap could be, by 2030, about 1.3 billion, okay? Now, what we can do is we can say, well, what if they didn't increase any shares, there's no dilution, well, how much would they be worth by 2030? Well, in that particular case, they'd be worth close to $40 a share. And then you could say, okay, but what if they actually did increase their shares outstanding by 25%, like we were talking about with their dilution? Well, if that happened, well, then all of a sudden you have to divide that market cap by the 41 million shares and not the 32 million. And then you would come up with an amount of about $32 a share. So again, you can see the fact that if you weren't taking into account that dilution, you see that potential to overstate it there. Okay. And then I have a couple different ways that I want to look at this. I think that, maybe one of these might be easier to understand than the other, so I want to cover both. But basically, if you were going to say that this was going to be worth $39.60 in 2030, you could ask yourself, well, how much would you actually be making on a percent basis every single year if that was to be true? So if you're able to buy it at $11.48, you sell it at $39.60, what's that annual return for you? Well, that would be about 14.7%, okay? And on the flip side, you could also say, okay, well, maybe it's easier not to think about what that return is going to be on an annual basis for holding it for 10 years, because maybe you don't want to hold it for 10 years. Maybe you're thinking, hey, I want to hold this for a year, I'm okay with that, but I'm not trying to hold this for 10 years. Well, there's a different way you can think about the return then. And you could think about, we would then take that 3960 and say, if that's what it's going to be worth in 2030, okay, then we can use the present value formula and discount that back and say, okay, 3960 in 2030, that's not as valuable as having it today, right? Because the time value of money, the further away you get from today, the less valuable that money becomes. And I always like to say, there's a really intuitive way to think about that. And think about, if you could be given $1 million today or $1 million in 50 years from now, which one would you rather have? And I feel like everybody would rather have it today versus in 50 years, because you think about, well, in 50 years, like with inflation, that money's going to have a lot less purchasing power. You're thinking, if I had $1 million today, I could be putting that in the stock market and earning a return, right? So, there's an advantage to having money today, and discounting this future value back to present terms just takes that into account, okay? But all that being said, that if you were going to assume no dilution and you were going to discount that 3960 back, you'd get a valuation of about $16.73. And if you assumed the full 25% dilution that I'm assuming here, then you would get an actual valuation of today's terms of about $13.38, okay? And then let's, by the way, just quickly take a look at what that would be from each price point here. So that 1673, that would actually imply 46% upside compared to where the stock is today. And if you think it's worth $13.38, then that would be about a 17% upside. Now, when I said that $16 price target, I think that I'm looking at is pretty conservative. What I mean by that is, if we look at the 7 and the 6 and the 5% growth, and we go back and we think, okay, well, this company was already growing by about 18%, and this was before having the higher return on investment of more aggressively pursuing the e-commerce channel. Well, you could say, well, what if they actually were going to grow, by that 18% in the next year, and then they grow by, let's say, 12%, and then by 8%. Well, if you start using numbers like this, which are, maybe more in line with the historical growth rate, which I think can be justified with that e-commerce approach, okay? Well, then all of a sudden you start getting into numbers where this could, easily be worth, $25, or even with the full dilution, about $20, okay? So if you think that this company can grow a little bit more aggressively, like I've highlighted here, this represents a lot more upside, okay? But even if you wanted to say that it was actually just going to grow by the mid to single digits, you would still see some pretty good upside. So this is why I think Duluth represents a good opportunity. I'm really interested to know what you guys think. If this is something that you already own, you're looking to buy this, do you agree with the analysis? Always remember to do your own research, by the way, before you're making any investment decisions. It's got to make sense with your portfolio. Definitely don't just take my word for it. But this is something that I'm going to be looking at adding a position to and holding for at least a year. So again, let me know in the comments below, and I'll see you next video.